Hey, Fearless. How is everybody tonight? Let me introduce myself. I'm Hermel Godbout, aka Mel Godbout, and I come to you tonight to talk about multifamily and quite specifically the basics of multifamily properties. Uh, and to give you a bit of information, we'll go very uh, basic tonight in the sense where I'm not going to dive into too deep on any given aspect of multifamily investing because there's so many aspects of multifamily that um, we could get lost in one specific branch and stay there for a while. It's very complex at times, but a very predictable market class. So let's see who's on tonight. We have from Ottawa, Babette, Spruce Grove, Alberta, Jules, hi, Lisa, Stanley, Heather Foy, and yeah, all right. Very nice to see everybody tonight. Thank you for coming. So to give you a little bit of introduction on me and the multifamily space, my wife and I started investing in real estate in 2021. We bought ourselves a duplex at the time. Hey, Karina. And we started seeing the benefits of having an investment property right away, with renting both sides in a very nice end of town. And we decided that we wanted to continue and scale. So we joined Fearless and then joined Ignited. And once in Ignited, we had a session one night with some Ignited members. We were the new guys in the room, so a lot of people wanted to say hi. And we had a conversation with one of our partners, and we dared ask him, like, how early is too early to get involved with multifamily buildings and investing, basically the big buildings. And he's like, well, as long as you have someone that has done it before to show you the way, it's relatively, doable. So we had further conversations following that meeting, and we've decided to officialize a partnership. So, of course, Benoit Sorel here I'm talking about, and then another Ignited member and another Fearless member, Nico Batista, who we decided to join forces with, and we've been working as a team ever since. Sorry, I'm just gonna. So Danielle, Christine, Angie, yes, all the beautiful people. So we've been doing multifamily since then. We made our first offer on a 40-unit building that same year, November 2021. And we closed that one in March 2022. We had another 16-unit close in June 2022. Another 82 units close November 2022. And we currently have 32 units under contract that is closing at the end of this month, and a newly 70 units under contract as well that we've just kind of completed due diligence on. And we've utilized MLI Select mortgage product for all of our properties. Bridge financing to MLI Select on some of them, or straight to MLI Select. So a lot of know-how on how to do those things, but steep learning curve. So let's start with the ultimate question: why multifamily? Does anybody have any idea or inkling on why people like us would want to invest in multifamily? Typically, we're talking economy of scale. And why I'm saying economy of scale is that these multifamily properties tend to have multiple streams of revenue. Give you a comparison. We had those duplexes in Moncton, and if we had a vacancy on the duplex, it would create like a bit of worry and hardship because we would just make, a mortgage payment and cash flow was gone. And uh, how do we collect, tax money for the yearly taxes? So we create a bit of upset. But with multifamily, there's always a ground zero where how many units do you need vacant to break out even without necessarily having to fork out of pocket the expenses needed to cover the cost of operating. And also, well, the positive cash flow of having one unit versus the positive cash flow of having any units does make a significant difference in how profitable they can be. But they do come with a larger price tag. So we'll dive into a little bit of the subject. Um, how do we source them? First of all, we spent 6 months, I'd say, building our team. We decided that we would go into multifamily, but not unprepared. So sourcing out the right real estate agents that could bring us deal flow, um, sourcing out the right mortgage broker that had uh, comprehension and understanding of the market. Also sourcing out the best or the appropriate inspection crew that would run your BPCA or your building assessments to make sure that the critical systems in the buildings are not just ready to fail. And we've also sourced out at that point engineering for environmentals, sourced out property management. We make contacts with contractors, suppliers, and then you go shopping once you have your team. So it felt like we were spinning our wheels for about 6 months. We were visiting a lot of stuff. We were underwriting a lot of stuff, practicing the numbers. And then once we started, we had this team ready to basically catch us and help us through all these acquisitions we've done in a short order. So get your team ready. That's the first. How do you know you have the right team? How much can you scale? And I'd say proof of concept in what we've accomplished here. We've scaled quite fast because we had the team in place to do it. What type of multifamily buildings are we talking about? Well, there's like row houses, condos, there's apartment buildings, tall buildings. Anything typically that has more than 4 units falls into the multifamily segment that we like to work in. Again, economy of scale. If you're going to do 6, do 12. If you're going to do 12, do 20. If you're going to do 20, do 200. Like whichever you can scale and do. The economy of the bigger assets do have this advantage. Market growth also affects, the ability to sustain a working multifamily building. So if there's demand for rentals, there's good market rents, and the community in which it's found is either a primary or secondary market. You can usually source out these properties easily enough and turn them over to good effect. Also, you want to look at the neighborhoods in which you find them. Sometimes you can find a diamond in the rough, but let's say a D neighborhood, you wouldn't want to pay overpriced for a building in there because there's usually the D demographic of tenants that live in those areas. So again, you want to choose your market, you want to choose your area in town, because I could sit in a B area of Moncton and have a very profitable building, but in the same city having a D area of the city with the same type of building performing poorly because of the overhead of having to operate in an unstable tenant base. Other real estate options, well, again, economy of scale. They it's really hard to beat the multifamily side because of the fact that they're resistant to a few vacancies. And I always like to consider or calculate my ground zero. Where do I break even? So, as I mentioned earlier, how many vacancies can we support before we start like breaking the piggy bank? So, if you can figure that out, let's say out of a 20 unit building, if you're 50% vacant, you can break even. That's pretty resistant to market fluctuations. Um, so cash flow generation from multifamily properties is also a very good uh, upside to having big buildings. Also, long-term wealth creation and appreciation. There's tax advantages. So we'll dive into a little bit deeper into all of these things. For now, I'm going to see quickly if there's any questions. No questions for now, so we'll move ahead with the content. So the demand for the rental housing market, well, we've never seen a hotter market now. I think across Canada, the demand for housing has hit critical mass. Population in Canada now has hit 40 million. I think just last week or the week before, I might be wrong. And there's an influx of newer arrivals to the country. Immigration is bringing in all these qualified workforce. And post COVID, there's never been so many jobs. There's so many vacancies, so many postings everywhere for people to find employment. And all these opportunities bring people that need places to stay. Hence, the multifamily market is booming in most big cities. Though cost of building and all that has increased, you're still seeing a steady supply of construction happening. Even though there's been a slowdown, I think the market's going to let it grow. And you're seeing interest rates go up, but interest rates affect multifamily space differently. And I'll explain on that a little bit later. All right, let's see. So I have some side notes here. I'm just trying to not go too randomly. Uh, and scalability. How can we scale this? Well, first of all, the importance of effective property management. How does that influence basically how quick I can scale? Well, if you have your property management set up to perform at a certain level, that the fees and the fee structures are acceptable. Property management is focused on tenant retention in areas where, like high quality tenants, you want to keep them for as long as you can, because turning over units can get costly. And I can vouch for that. We've turned over, I think, 43 units in the spring at our student housing areas in Sackville, and 43 units turned over, 38 move-ins within 5 days. That adds up pretty quickly. So again, strategize operations to maximize returns, laundry, storage, parking. How can you generate extra income, furnished units, name it. Just stretch the envelope a little bit. We have a building that we provide all furnished units, premium finishes, and they rent. There's a demand for them. So we put them out as available. We rent them for a little more, optimize our revenues, and kind of works really well for us. And then leveraging economies of scale. So if you have 16 units furnished, they add up to a lot more dollars at the end of the month, right? So scaling that way. How do you do due diligence basically on the market that you're in? Well, of course, boots on the ground is always a good thing to have for any area in which you want to invest, especially people that know it well. I have a goal, and my goal is to become a coast-to-coast investor eventually. So having assets outside New Brunswick, I'm aspiring to looking at other provinces to start investing in. So before setting up, I would find someone local and partner with them, and then get their opinion on the market and get their opinions on how and where it is best to grow, and then get their insights on the market. Um, Also, having your due diligence in the early stages of purchasing some properties. Um, First of all, they're required by the banks. No banks is going to give you a $50 million loan for buildings that have not been inspected. This is your time to go see these properties. They're big ticket items, the expensive stuff. You want roofers on your roof. You want engineers on your roof. You want people looking at your boilers. You call the maintenance crew that does the boiler maintenance for those properties. Ask them for a report card. When you're doing the walkthroughs, request a minimum of 50% of units to be seen before closing, and then choose all the basement units if there's any ground floor or basement units, just because those ones will give you a fair idea of the condition of the building. So if the basement units are pristine, probably the rest of the building will follow suit. If the basement units looks like they're suffering, that's a good indicator that, or a reflection of the rest of the building. So those are little tricks that we look at. You want your environmental done, phase 1, and phase 2 sometimes is called. More sampling, that's very expensive, but you can't get a mortgage for those properties without an environmental. And then an appraisal. The bank wants to know what you're buying and what you're paying for it is equal or greater than what your offer is. So, because if it's not, someone has to make up the difference, and they don't want to make up for it. So depending on your loan to value, if you're borrowing for 80% and there's a $400,000 difference between the appraisal and what you're offered, someone's going to cover the difference. So if it's you overpaying, then you have to come up with that money. And how are you going to make up for it? So that's the importance of doing proper due diligence, guys. And now with the MLS Select product, there's a lot of people that are looking at the energy efficiency, and the energy efficiency audits, get them done early as within your due diligence, because then you want to know if you have that option coming out of due diligence right off the bat. So what does that mean if all of these things are done and your deal doesn't work? Your inspection is awful. There's something to be done with the roof. The appraisal comes in under. The energy options are not adequate. What does that mean? What does that say to all that due diligence money you've put in? So all that due diligence money you've put in, that's kind of your risk capital. This is the cost of doing business in multifamily buildings. If it doesn't work and you've spent $20,000, $30,000, $40,000 on all these professionals' opinions to get your team to work for you, well, sometimes it's the cost of doing business. You have to walk away. And that $40,000 might be less of a loss than if you overpaid on an underperforming building that needs major repairs that you end up coughing money for. So again, there's that higher risk is that due diligence won't come in. And that's why, as working partners, we get paid. We basically make sure that our equity options in the deal is equal to our risk, because we don't get investor money for the due diligence. That's typically something we put out of pocket. We put the risk capital in play, and if we lose, nobody else goes down with us. So, and that's the cost again of operating and doing business. All right. Okay, any specific questions at this time? So, Heather. So if I started building my team having only a duplex, did you rely heavily on your partners to build your team? How did you build your credibility? So basically, yes, that's a very good question. We did have to kind of chip in. Everybody brought something to the plate. We didn't like the local inspectors and the people that would help us build the on ground inspectors, appraisers, all that. We Rachel and I brought that to the team. And then with help, we've managed to find an out of province broker, and then law firm that with a mentor's recommendation, a law firm that did securities law for us and helped us draft our LPAs and LPGP structures. So yeah, it was a team effort, Heather. Uh, do you have a template for your team build? What sort of team? What has worked best for you? It's basically the same team, same like for you kind of replicate what works, right? So if you look at a template, then you would need your crew of engineers that do the BPCA, your crew of engineers that do the ESAs, your appraiser, and then your energy efficiency studies, and then yeah, and you're off to the races. But that's only complemented by, of course, the whole ability to structure everything together with a good lawyer and a good mortgage broker. I can't stress that enough. All right, I think that's all for the questions we have for now. So once, yeah, I'm happy that clarified things, Lisa, for the initial due diligence investment. So again, the market trends for the multifamily are on the rise, so that's a very favorable asset class to invest in. So the multifamily sector in Moncton is booming. There's, I think, over 2,800 units in construction right now in the city, where I think 12,000 is the inventory. So we're adding about a little less than 20% more inventory currently in this year. So it's booming. Okay. More notes. So what's also more predictable with multifamily buildings is that if you have a steady flow of tenants, and if your occupancy is right, and you strategized your stream of systems optimizations, that which directly has an impact on your NOI. So the more money a multifamily building makes, the more it's worth, because the valuation process to a multifamily building is typically based on revenue. They'll also influence the replacement cost, but mostly revenue is the way how they price them. So by optimizing your rents, optimizing your income from different areas of your building, you can basically increase the value. If you increase density, so if you add extra units to lost space, if you add bedrooms to units that had extra room, creating more income that way, then the property value raises significantly. Also, on the year-to-year inflation, multifamily properties tend to go up in value. Like they say, passive appreciation doesn't really apply to multifamily, but it tends to go up in value equal to the minimal inflation target by the Bank of Canada every year. So most of you would know that the minimum inflation target year to year for the Bank of Canada is about 2%. So 2% on 10 million, year 1, year 2, year 3, year 4, year 5, you've seen 10% passive appreciation, let's say in 5 years. Is it a reliable marker? No. But if you increase your rents by 2% every year, depending on the market you're in, what your tenancy board allows you to raise for rent increases, that will usually match the increase in value. How can you build active appreciation? By renovation, by adding uh, you know, rooms, by adding revenue, or renovating units, making them fresh, making them new, cycling tenants, stuff like that, which helps with creation of revenue, and then value will go up. So this is kind of the more forced appreciation. So and hand in hand, then you build yourself equity. You have your mortgage pay down by multiple tenants, and let's say every 5 years you decide to enter a 5-year remortgage model with your investors, and then every 5 years you can basically have equity to benefit from that builds passively and actively with your efforts. And the demand. Perfect. So urbanization. So we're seeing a lot now of properties that are being built, or multifamily buildings are being built in urban centers that bring all these, trendy type of rental units, which basically help people get to work because it's close to everything. Built-in gyms, built-in amenities, a ground level commercial area where you basically walk down from your tower into a loft area where you have multiple shops. You can do shopping, you can get your coffee, you can go, and get several things right a walk away from your front door, basically. So there's a lot of to be said about the walking score to these buildings that are created. And I'm going to give you the example with some of our assets, and I do mention them often, but we have currently 98 units in University Town, all within 5 minutes walk away from all the campus buildings and the student center. So the advantage to that is we tend to gather a lot of students that want to rent from us, not because we cater to them, it's because by default we live right next to our buildings are right next to the university, and it makes it a perfect spot for them to rent. So again, just for that benefit of proximity, sometimes you get an extra tenant base that's very stable, or for us, in case of students, it rotates naturally. Most students are in school for 2 to 4 years, and then when they rotate up naturally, enabling us to do slight renovations and then find new tenants and keep rents up to market. And of course, a reliable tenant base is always the key element. That your customers are your tenants. Retention of your tenants' strategy should also be on the forefront of your mind. A lot of property owners that have a local building, if you're close to your buildings, I recommend you walk them once in a while, talk to the tenants. There's a lot to be said with that, from that relationship. When you introduce yourself to your tenants as I'm the owner, it has an impact because they know you're around. They know if there's any issues that you actually care enough to show up, right? So I'm not doing this we're not saying this to say people that invest from afar and are owner from afar are neglectful in doing it this way, but it should be conveyed to your property management team that tenant respect, tenant retention, and they're the face to your company while you're not around, right? They're your representative. So if you don't like the way they represent you, or they don't represent you the way you'd like them to, it's something to be corrected, because tenants, or there seems to be like a 3 to 5 year memory in tenants. like if something happens, there's a 3 to 5 year period of time where people will remember it inside buildings. So and then it kind of phases away. So you want to put your right foot forward and the right attitude to the tenants for sure. Um, and multifamily buildings, as a general rule, are tend to be resilient to economically speaking, tend to be more resilient in the sense where um, during hardships, during market crashes, during anything that has like depressions, people still need somewhere to stay. Uh, let's say in the current environment where we're seeing a lot of interest rates going up and people didn't lock up their variables at 1.7% because they figured they could get better for a few months. The variable rule, like variable always wins. Those those people that are feeling the pinch from that 6.5% now, or I'm exaggerating, but it seems like a 6.5% increase so far. Uh, they're feeling the pinch, right? And what happens if it goes up another 1%? People are going to eventually be forced out of their homes because affording them will be a challenge. Where do they go after? They rent an apartment, right? They rent their apartment that they can afford because it's predictable. It won't go up 1% every month or 4 times a year. It'll go up as permitted by the RTT, and it doesn't come with associated costs, maintenance, taxes, insurance, all this stuff. Renting an apartment is pretty straightforward. So a lot of people would say, well, if you can afford paying this in rent, why don't you buy a home? There's a lot of hidden costs in owning a home that you don't necessarily put on paper. But at the end of the year, when you buy a house, you definitely feel the pinch of all these extra costs added to it. Um, yeah, so that's the necessity for housing creates um, a reliable market. And sometimes, people will migrate from a center, and you'll see a lot of tenants moving away, the loss of jobs, a company shut down, and then you're starting to see vacancies in your multifamily building. So the importance there with the multifamily building, if you've refinanced and financed smartly, then it's resilient to these changes that are going to happen. Um, so again, that where do you break even rule, right? How many vacancies can I support before it starts munching on my pocket or my wallet, right? Uh, all right. So I'm going to take a little break from my content and see if there's any questions at the moment. So I suspect a refinance gain can be instrumental in paying back investors in your family properties. Have you ever had to contest the results of a commercial appraisal? If so, how did you go about working with the appraiser to discuss your valuation of a property versus theirs? So recently, we've had bank request another appraisal. At their request, we decided to provide another one, which would have caused a little bit of a huff and puff had we not partnerships in town. This is kind of hiding half my face, hey guys. Have we had not partnerships in town to allow us to get another appraisal done? Like his workload was like 12 weeks, and because we know him and we called in a favor, he turned it over for us in 2 weeks, which was amazing. It satisfied the bank. And so sometimes it's not the question of um, contesting the appraiser, is if you're allowed to get a second opinion. In multifamily investment, the appraiser works for you. You hire him. And he's on your team. Typically should have a conversation with you as to what the goals are with the property. What do you want to lift it to? What's the lift potential? And then they do a market analysis because they do their own. They do the rent analysis. They do the rental unit analysis, vacancies, all that. They'll come up with a bunch of statistics to satisfy the banks. But ultimately, if you don't like what they've turned in, you can hire someone else. You can hire a second opinion, and then say, hey, guy, team A, you've come up with this, and team B, you've come up with this. Can you guys have a conversation and find a middle ground, or just use the best of the two? Compared to a like a residential appraisal, uh, which are typically asked for by the bank and paid for by the bank, and you're not always privy to the results. And the bank will always want to do their own. They work for the bank at that point. So in multifamily, it's not the same relationship. So having to refinance to pay back investors is also, yes, a very real concern. But that's why we utilize every tool uh, available to us in the book right now to help us have these properties perform. And what's available right now in the multifamily financing market, there's the MLI Select product that gives you up to 50 years amortization and a really good rate. How do you get there? With the energy efficiency pathways, the accessibility pathway, or the affordability pathway, or the three of them. You could combine them all to get your 100 points, and then get your certificate of insurance that way. And then you lock your rates, and hopefully that will weather you long enough to your next refinance and then help you repay your investors. So if you have debt on the purchase, if you've borrowed money to help you pay for the initial cost of borrowing or buying these buildings, you're allowed to pay that debt back, right? So on the refinance, let it be from a bridge or straight or refinance with CMHC, they'll typically let you cover the debt from the initial purchase. All right. What else can we cover here? I'll take questions now if you want to. Otherwise, I have a little bit of material left. Okay. Not at the moment. Perfect. So yes, so the ability to sustain market fluctuations, market crashes. So those buildings, people will always need somewhere to stay, and those incidental vacancies that you get sometimes take the time to turn over your units, make sure they're tip-top shape for your next tenants, and then the advantages of knowing your tenancy laws will help you basically weather the storm. Having people commit to longer leases and a softer tenant base depends on are you favoring elderly people in your buildings, and are you looking for them to stay longer? Are you favoring students in your buildings, and are you looking for them to rotate more naturally? All questions you should basically ask yourself at the start of your acquisition. Make sure that these tenant bases help you weather the storm as much as you can. All right. So in a nutshell, that covers a lot of the basics, and there's a lot of fine branches on which I could expand right now. I find that it's kind of a rabbit hole if you start down one. It can get pretty it can suck you in. So I'll continue with questions. Ooh, here we are. When buying a new building, do you open a new company each time? Depends on the structure you utilize to buy. For us, the way we've been operating so far, we do open a new entity every time, or create a new entity every time we buy. and let it be that this entity will post or will buy along with investors or without investors. We do create them each time we buy, and that's to basically, you don't want all your eggs in one basket, right? So let's say I have one building that fails inside of the company. I don't want all my other assets at risk and all the investors that have invested with with that with those assets at risk as well from one failing building. So you want to keep the assets separated as much as possible to help you mitigate that risk. Now, if you're the only sole buyer or purchaser and you're pretty risk adverse and or you have enough cushion to weather the storm, then you can hold as many buildings inside one company if you want to. But if you're doing investor-based purchasing, different entities should be holding them for sure. All right. So I am reachable. You guys can always find me at djcpropertiesinfo@gmail.com. And that's our main business email. This is where I respond to every day. We are, like I said, currently in the acquisition stages, and we're due diligence of 70 units that's just complete, looking very, very favorable. We still have a few things to go over, but we'll be presenting that as an investment opportunity soon to our community. We tend to go to our mailing lists first. So if you want to be part of our mailing list and receive our opportunities first before we go to market, before we go public, basically, we send to our mailing list first. So that way, people that are subscribed get a first peek and first crack at our investments. And if you want to be part of that mailing list, contact me at DJC Properties Info. I'll add you to that mailing list so you get first peek at the new deals coming up. The advantage to that is also we have early bird options oftentimes. So basically, if we sell equity or if we have equity options available for LPGP structure, and you can buy shares of the company that's going to own and profit share. If you're part of our mailing list, you have access to the early bird shares, which are 10% cheaper. Stuff like that we throw into to make it worth your while to look at our stuff when we send them out. So again, reach out. We're happy to take calls, happy to take consultations, and here's a new question here. Let's cover that. This is from Sarah, my old friend Sarah. So for a newbie wanting to move into multifamily, there's a lot of moving parts. You make it sound easy. How long did it take you to get into that place, and how much learning versus learn as you go did you have to do? Very good question. How long did it take us? Well, let's say working as a team really helps, because we would kind of separate tasks, and if there was a bunch of learning to be done on point A, point B, point C, there was no point in all of us learning that at the same time. We would each separate a task that needed to have a bit of skill and understanding, and then after we found our results or answered the questions, we would bring it to the team, and as a team approach at that point, kind of share the information, share the love. So how long did it take us? I think after our first 40 units, we had learned so much on how to do and not do stuff, and how to add and just the tidbits you learn along the way. Had I known, I would have, hindsight's always 20/20. But we've learned so much from the first deal that after we've structured the first and completed the first, we were ready to move on with improved, like you improve your your operations every step you take. So if you can constantly improve and constantly make the opportunities better and de-risk your investors as much as possible, there's definitely a lot of a lot of to be learned in a short order. The difficulty comes in if you're a sole provider or a sole operator where your team is yourself. At that point, learning curve would be very steep and lots of operating pieces to go. I always say, find yourself a good mentor. Find yourself someone that's done it before. There's power in partnerships. Choose your partners closely. Due diligence, on your partners as well. You don't want to do all the work and reap and have everybody reap equal benefits while you're pulling all the weight. You want a partnership that it's kind of a shared opportunity for everybody, right? So that will bring you that comfort to scale. And people always ask me, Mel, what's your door count? Door count's just a number, and it's like a vanity thing. It's like, oh, I'm 260 doors, I'm 350, I'm 500. Where are you happy? Where do you stop? I love doing multifamily buildings. I love doing this part of the real estate market. And I always say my humble goals is 5,000 doors. And I say this while kidding, but also kind of serious in the sense where I would not necessarily say, hey, let's stop at a 700 or let's stop at 750 or let's stop at 5,000. Let's make that number real big, right? Just because I've caught myself kidding around about stuff that I now own. Like we were driving around town, Sackville one day, and we were looking at the buildings we now own, laughing in the car and saying, one day I'm going to buy those. And one day we did, right? So saying casually while laughing, humble goals of 5,000 doors. We'll talk to you when we get there. So I have aspirations to grow and continue to grow. And as long as I love doing it, I will keep on doing it. So that's, a little bit about us. If you're bringing value to the community and your investors, why have a ceiling doors number? Ceiling doors or like a total. Yeah. Oh, I'm saying 5,000 just because I could say 12. I'm trying to be humble. That's why, Jules. And bringing value. Well, that comes with this community, fearless and ignited. It brought so much knowledge to us in times of uncertainty, in times where we were beginning and we needed someone to help us market and help us promote our deals. This is very, very friendly community in which it's safe to learn and ask questions and grow. So of course, bringing value to the community is something I want to do and continue to do. Do I have higher hopes of eventually moving on to helping people learn all of this in more detail? For sure. But for now, I'll try to bring value as I can as we grow. And we're in a very busy period right now because we're repositioning so many buildings and stuff. But once the machine is rolling and we've nailed down a few more projects, I think we'll be able to get more structure behind like learning packages and stuff like that to help again bring value to the community. But for now, I'm just email away, and I'm happy to take calls and questions. And I hope everybody doesn't hesitate to reach out. It might take a day or two for me to answer, if you're not on my mailing list. but typically we get back to people and have hopefully answers to questions they might have. So I'll leave it at this for now. If there's any more questions, I'll take a few more. Otherwise, I'll bow out and let you guys enjoy your evening. And hopefully, this was of good value to the community. Thank you, everybody, for the comments. I appreciate all your cheering. All right. Well, I'll say adios for now. Thank you very much, everybody, for coming. And to Igniteds in 9 minutes. Here we have another Ignited session tonight. So have a great night, everybody. Ciao.